Equities rallied to end the week after a terrible performance Monday through Thursday, but the stocks still closed lower for the sixth consecutive week. The sharp move higher Friday came after the Fed chair reaffirmed on Thursday that two more 50 basis point rate hikes were on the table for the next two Fed meetings, and that officials were not actively considering a more aggressive 75 basis point hike. Just a day earlier, the S&P 500 had closed within striking distance of a bear market, which is typically defined as a close of at least 20% from a recent record high. What was interesting to me was that Treasury yields spiked and then paired their gains, and yet the stock market kept selling off. At the same time, the VIX seemed to have reached a peak with a similar cool-off move. Yet again, the markets continued to sell off. So it appears the markets have more on their mind with two major inflation reports that came in hotter than expected. The PPI showed an 11% year-over-year rise in wholesale prices last month, while the CPI showed continued elevation at an 8.3% annual increase in prices paid by consumers. The conclusion is the key to the markets right now seems to be interest rates. With a rapid rate increase, the markets have been shocked. Once rates begin to stabilize, then I think the markets can catch their breath and maybe calm down. So let's start with a look at interest rates. And this chart here is the 2-year weekly chart on the U.S. Treasury, the 10-year, and the symbol is $UST 10Y using stockcharts.com. Now, as you can see here, back in, say, mid-2020, you can see that bottom there, and from that point, we started seeing higher lows. And you see this kind of stair-step move with stocks as well as indices, and certainly now with Treasury yields. So we're moving on up, but it looks like we may have a possibility of some stabilization up here near 3%. Looking at the upper portion of the chart is the RSI. You can see that it built above this level here, which is 70. It built up there for the last few months or so, and now may be coming on down. And you can see here in the lower portion, looking at the MACD, that also that move continued on up here with a fast line above here, but it's barely turning sideways, so it may be cooling off. Now, if you look at the daily, it certainly has had a couple of days move on the downside, and that's what I was saying, is that it's surprising to see both the interest rates and the VIX start cooling off, and yet the market continues to sell off. So now let's go ahead and take a look at the VIX. And now we're looking at the 6-month daily chart on the volatility index, and the symbol is $VIX using stockcharts.com. Similar to interest rates, we have higher lows. But look here, this trend line, if you can draw a horizontal line this way here, you can see that each move from here December, here in say February to March, and then now it seems to be stopping at that 36 to 38 level. Currently we're at 28.7, so I would imagine, based on what's happened here in the recent 6 months, we could be on our way down. And when the volatility index moves down, then the stock market moves up. So that's what I'm looking for. And up here in the upper portion, you can see the RSI also cooling off. And you can see down in the lower portion here, the MACD, where the fast line looks like it's about to go through the slow line, which is in red. The black is the fast line. Now, going back to these other circumstances, once the black line moved through the red line, then the VIX calmed down and the markets had rallies. Now, that's what I expect. I've been expecting it, so hopefully it's going to come due. Let's now go take a look at our charts. And now let's go quickly through the 6-month daily chart on the spiders, the SPY, and the close on Friday was 401.72. So as you can see, we've got this trend line heading on down here like that, and then the upper trend line heading down through there like that. We're well below the 20 and the 50 EMA, so we have a lot of work ahead of us. Can we make it up and through that? Only time will tell, but once again, I'm going to say the probabilities are that we're going to have an upward move. Will it continue? We'll see. Moving here into volume, at least volume is cooperating a little bit on the downside here. You want to see a declining volume with a declining stock market so that there are fewer and fewer sellers, and then hopefully the buyers build and build. Into the MAC, you can see that we failed once, we failed twice. Hopefully we will not fail the third time here. Looking in the histogram, definitely a pretty good serious downdraft here, but in the last, say, several weeks, we've been doing some backfilling and trenching and digging, trying to create a bottom and base here. It does look like we may be heading on up, but this is only preliminary right now. I want to see more progress next week. And into the price rate of change, pretty much the same thing. We are pretty deep here at that negative, say, 24.32. I want to get closer to that zero or midline so the market can strengthen. Here in the RSI, it does look like it's strengthening here. It's a pretty big dish down here, at least as the 6-month daily chart goes. We're at a 40.12, which is moderately weak. We need to get up there to that 50 or midline and above. The same thing here for stochastics. It really needs to charge out of that oversold territory, and the same thing for Williams. It spent too much time down here bumping up and against that negative 100 level. We need this to move out of that negative 50 or midline area and on up into that negative 20 to the zero area. The Williams will be one of the first oscillators to move on up, and if that can get above that 50 convincingly, then it will pull the other oscillators as well. Back up here to the price chart, one last look, and here's hoping for some recovery into the next week or two. And for today, that's ChewDog Charts. Thank you.